Welcome to The Explainer. Today, we're tackling a really fascinating and honestly often misunderstood company, Poongsan. Now, keeping with our theme of not exaggerating things, we're going to completely skip the market noise and the wild rumors today. We're just looking purely at the unexaggerated structural realities of what they actually do, how they generate value, and why the market seems to struggle to price them accurately. Let's jump right in.
Is it a copper company or a defense company? That is the central paradox here. Traditionally, the market looks at Poongsan as this somewhat heavy, undervalued legacy business, something tied to volatile raw materials and stable, but let's face it, unexciting military contracts. But to understand its true value today, we kind of need to completely toss out those old labels.
Okay, let's dive into this. Let's start with the baseline facts. When you look at their revenue breakdown, the story seems pretty straightforward, right? About 70% of it comes from their Shindong, or copper manufacturing division. That leaves just 30% coming from defense and ammunition. So looking purely at this top-line split, you'd rationally assume, okay, Poongsan is primarily a copper business.
But as is often the case, revenue doesn't tell the whole story. Let's look at the actual cash generation. 75%. That is the share of operating profit generated by the defense sector alone. Think about that for a second. The 30% of the business making ammunition is quietly generating 3/4 of the company's entire profit. It's a massive asymmetry, and honestly, that one metric fundamentally shifts how we need to value this whole entity. No exaggeration needed. The numbers speak for themselves.
Which brings us to Section 1, Engine 1, Defense, the quiet cash cow.
So Poongsan has really evolved from just a domestic supplier into a major global player. On the growth side of things, there is a verified structural global shortage of 155mm artillery shells right now. Plus, as giants like Hanwha Aerospace are exporting tanks, Poongsan's ammo gets bundled right in with those deals. But keeping grounded here, there are very real risks we have to weigh. For instance, a sudden easing of geopolitical tensions. That could shift market sentiment literally overnight. There's also the lingering threat of Hanwha pushing to manufacture its own ammunition, which would essentially turn a vital ally into a direct competitor.
And we have to remember, Poongsan isn't operating in a vacuum. In the NATO standard 155mm market, they are up against some massive, deeply established heavyweights. We're talking about Germany's Rheinmetall, who is rapidly expanding their capacity, alongside the US giant General Dynamics OTS, Norway's Nammo, and the UK's BAE Systems. It is a fiercely competitive global arena, and expanding market share here takes immense scale. It's not a walk in the park.
All right, let's transition over to Section 2, Engine 2, Copper, Infrastructure's Hidden Veins.
Now, historically, the copper division's fortunes were tied straight to London metal exchange prices. But today, the supply chain is just so much more specialized, and this brilliantly illustrates how it works. You might actually wonder why Poongsan's name doesn't show up on direct sales to major tech infrastructure companies. Well, it's because Poongsan produces the raw, high-purity copper in rods, which then flow through this whole network of mid-tier subcontractors. Those subcontractors are the ones handling the machining and assembly, eventually supplying the finished components to end clients like LS Electric and Hyosing.
So we aren't just talking about standard household wiring anymore here. AI data centers and electric vehicles require components made from highly specialized materials. We're talking about things like Poongsan's Corsan alloys and thick bus bars, which are needed to handle immense high-voltage electrical loads without, melting. High heat resistance and perfect conductivity are absolutely non-negotiable in this space, and that is what's driving a structural, long-term increase in demand.
The growth indicators here are super clear. AI power grids, EV infrastructure, and rising LME copper prices all give their margins a nice boost. However, the downside risk is pretty straightforward too, a global economic downturn. If infrastructure spending stalls out, copper demand drops, and that hits this division's profitability immediately. Again, keeping it to the unexaggerated facts, it's a cyclical risk you just can't ignore.
And just like with defense, we have to acknowledge the intense competition here too. Domestically, rivals like Li Quan Industrial are aggressively fighting for that EV market share. Internationally, Poongsan faces premium tech giants like Germany's Wieland in the alloy space, while massive Chinese companies basically dominate the high-volume pipe market. Securing a strong position here takes relentless precision, so yeah, for sure, it's far from an easy monopoly.
Moving on to Section 3, the Valuation Puzzle, looking at spin-offs and M&A reality.
So, let's look at the unexaggerated financial reality here. Poongsan carries a pretty significant debt load of roughly 1.13 trillion Korean won. Now, normally, a number like that pressures a company to sell off assets quickly, right? But remember that 75% operating profit from defense we talked about earlier? That division generates so much reliable cash flow that management is under absolutely no immediate pressure to sell anything at a discount. They can very comfortably service their debt.
And really, this dynamic explains the failure of past M&A discussions, like the big one with Hanwha. Industry estimates actually value Poongsan's defense arm alone at up to 4.7 trillion won. So when you hear about a reported asking price of 2 to 3 trillion won, it's entirely logical. It all comes down to one simple operational reality. Poongsan will never sell for cheap. Fact is, financially, they simply don't have to.
So the crucial point is, why does the stock price often drop whenever M&A news hits the wire? Well, it really comes down to two highly rational shareholder fears. First up, the fear of losing the cash cow. If that highly profitable defense division is sold off, shareholders are left holding a much more volatile copper business. Second, there's the fear of succession-driven restructuring, where corporate moves are seemingly designed to benefit the controlling family's succession plans rather than actually maximizing value for the minority shareholders.
To bridge these valuation gaps, analysts frequently discuss the idea of an equity spinoff. The mechanics of this are actually pretty simple. Basically, the company formally separates into two distinct entities, defense and copper. Current shareholders would then receive proportional shares in both of those new companies. Then, the market independently re-rates the new stocks based on their own merits. Theoretically, this is a clean way to unlock the hidden premiums for both sectors without diluting current ownership. At the end of the day, the fundamental cash generation of the defense side and the critical utility of their specialized copper remain unchanged facts. So, the ultimate question is this. When the geopolitical noise and all those M&A rumors finally fade away, will Poongsan's unexaggerated intrinsic value finally be recognized by the broader market? That's the real puzzle you have to weigh against their current valuation. Thanks so much for joining me on this explainer. Keep learning and stay focused.